Good evening, everybody, and thank you for taking the time to come and hear this webinar. I hope everyone can hear me and the sound is working fine. I would like to begin by saying that although 2024 was a very challenging year for us here in Israel, from a pioneer point of view and market point of view, it was a good year. I'm very happy with our portfolio positioning. Our portfolios did very, very well in 2024 when we compare ourselves to relevant benchmarks and to peer groups and competitors. So we're very happy with our portfolio positioning, both our global strategies and our shekel strategies. So there's that, and we welcomed a whole lot of new clients to Pioneer. So from that point of view, it was a good year, even though it was a very challenging year for us here in Israel, and hopefully 2025 will be better. What I'm going to do this evening is my usual format for webinars, which we're going to look back and see what's happened in the market, try and get a sense of what's happening in your portfolio and where the performance is coming from. And towards the end, I will talk about 2025 and how we're approaching the known unknowns of 2025. I also will be addressing the two most common questions which I'm hearing, which is the stock market at a peak? Is the stock market too high or overvalued? That's probably the most common question that we're getting. And also, especially from our English-speaking clients, about how is Israel really doing and what is the cost of the war, etc. So I'm going to do a little bit of economic analysis on Israel, a little bit more than I normally do. I've got some economic graphs there. Please forgive me for that. I'm more of an asset allocator than an economist. Economic graphs for me is always feels like I'm reading the tea leaves, and there's no real one definitive data point which helps you predict the market. So economic data is always a bit funny, but at least it helps us understand the overall situation. Okay, so without further ado, let's dive into it. Oops, slide didn't change. Okay. 2024. So a strong year for equities, driven by the big seven, the mega cap seven. That's the Google, Facebook, etc. I'm going to show you some numbers about that. Why did the US economy do so? Why did the stock market do so well? And that's because the economy did better than expected. People were expecting higher interest rates to eat into profitability a lot more than it did, to eat into economic growth a lot more than it did. Some were even expecting a recession at the beginning of the year, and that not only did the recession not happen, but the US had some pretty strong growth 2024. So there was a positive surprise economically that contributed to the market. The artificial intelligence theme is still a big supporter of a positive risk appetite. I'm going to talk about that as well during my presentation. Inflation largely under control. Then Trump, the ultimate capitalist, won the election in November, and we had a boom to the equity portfolios in November, gave some of it back in December, but a very strong start. So our portfolios were well positioned for that, and we enjoyed that performance. On the bond side, it was a bit more challenging. Remember, long-term interest rates is what affect bond prices. What you read about the Fed reducing rates is short-term, the short-term interest rates. The short-term interest rates are coming down. Long-term interest rates went up. And the long-term interest rates going up is what hurts bond prices. Interest rates up, bond prices down. That hurts longer bond positions. Our portfolio duration was much shorter than any bond index, so we felt it less, but still a difficult year in bonds. Nowhere like 2022. You know, the 10-year went from 3.8% to 4.6%. That's 80 basis points, which is quite a lot for a calendar year. Most of that was in the fourth quarter, and that's going to hurt the bond portfolio. So not much we can do about that. Another thing about bonds is the spreads are very tight. There was a question about this in registration. What does it mean when the spreads are tight? When we buy a bond, we expect a certain return over US Treasuries. US Treasuries is regarded as your risk-free asset. So for example, investment grade bonds, we would normally expect 1.5% over and above the treasuries. Right now, that spread is only about 1% on average for investment grade bonds. So that's a little bit tight. Doesn't mean we stop buying bonds. We still buy bonds, but that's the environment in which we operate. So that's a brief summary of 2024. Let's have a look at how the indices did. Now, as I lead into the discussion about is the equity market high, I'm going to be throwing out sort of comfort points. Nothing is definitive, and it doesn't mean the stock market won't fall. Everyone knows equities can fall at any time, but there's a few comfort points that we can hold on to, okay? So the S&P 500 did 25% in 2024, very, very strong. Over the last 3 years, it's done 29%. So I'm not sure if you can see my mouse moving around here. The 29% on the right. 2022 was a negative year. 2023 was also a very positive year in the 20-something% on the S&P 500. But if you look at your 3 years together, it's around about 9-point-something% annualized, which is pretty much what we've come to expect from the S&P 500 since the global financial crisis of 2008. Pretty much 2009 all the way through to 2024, we've been expecting about 9%. So that's one possible area of comfort. The NASDAQ, very similar results to the S&P 500. The NASDAQ has more concentration risk around the mega caps than the S&P 500 does. So that's a factor. We kind of expect more from the NASDAQ because it's perceived to be riskier than the S&P 500, but it produced very similar returns to the S&P 500 over 2024 and the last 3 years. MSCI World, this is the broadest global equity index, only 18% only in 2024. Most of that is the United States. The United States used to be about 55% of this index. It's now about 62%. 62% is coming from the USA. You can see the rest of the world really didn't add much in terms of equity growth. It's all coming from the USA. The 3-year number similar. Tel Aviv had a very strong finish to the year. The fourth quarter was plus 16%, and the full year in shekels was 25.8%. The last 3 years, 16%. So the last 3 years is not as good a number, but it's not a terrible number. You know, roughly 5.5–6% for the equities. It's not a terrible number. But in order to have enjoyed this 15% in Q4, you had to remain invested and remain convicted to your strategy through some very, very challenging times in Israel, which was not simple for everyone to do. So provided you remained invested and did not panic, then you enjoyed that return, which mainly came in the fourth quarter. China was an interest, very volatile. It had a roaring start to 2024. I think it was up about 40% at one time. Gave it back in Q3 and Q4, finished the year at 19%. But over 3 years, China is still a negative number. That's equities in China. So you get a lot of volatility with China. I still like the size argument with China, but the volatility is just too high. And we don't have any China in our portfolios. The global investment grade portfolio, this is what I was talking about in the brief introduction. It suffered from higher interest rates, mainly coming through in the fourth quarter. The fourth quarter was when Trump won the election. The equity market did very well and the bond market did badly. But the big problem with bonds is your 3-year number. Still suffering from 2022 on a 3-year basis. And that's your global aggregate bond, which is one of the broader bond indices. It's longer duration than we would have in our portfolio. Treasury bonds are similar to the global ag. Israeli bonds did better than American bonds because they didn't have as bad a 2022. And in 2024, 5% on Israeli corporate bonds in shekels, perfectly acceptable. That's pretty much what you'd expect. Last 3 years is obviously a disappointing number, but nowhere near the others. And the global corporate bond index, corporate bonds tend to be a little bit shorter, have a little bit higher coupon, so they did a little bit better than the broad global ag. Hedge funds, somewhere in between equities and bonds. This particular hedge fund index is a little bit too equity-like for my liking. I prefer true hedge funds, but it is what it is. Okay. USA all the way again. The USA is leading the way. If you invested anywhere other than the United States, more specifically in the mega cap companies, your performance seriously underperformed. Some of the active managers, the famous active managers from around the world that I follow, their performance has been terrible this year because they were not enough in the mega cap stocks. The mega caps, who are they and what did they do in 2024? NVIDIA, an outstanding, unbelievable 171%. Facebook, Meta, Google, Apple, these are all very strong numbers. Tesla, 62%. Very big companies, very strong numbers. Okay, so we enjoyed it, but yes, there is a source of concern about these mega caps. I'm not going to lie, but we're looking at 2024 now, and you can see America 25%, Europe, which is the Eurostoxx 50, the largest 50 companies in Europe, 4.6 in dollars, Japan 8.6, emerging markets 8, France negative, Germany 11, UK 7.5. Really, you had to, if you wanted to make money, you had to be in the US and you had to be in the mega caps. Drilling into the S&P 500, see some of the companies behind that. We are asset allocators, but behind all the asset allocation decisions is companies. So here we have ranking by performance. So in percentage terms, who were the good performers? And the interesting thing here is not all the good performers are the mega cap. There's a few surprises in the best performers. United Airlines, certainly how they are doing so well is interesting. Constellation Energy, Netflix, Royal Caribbean, those are companies which you wouldn't expect to see such a strong performance. And then on the negative side, there's Super Microcomputer and Intel. Those are chip manufacturers. You'd think in a year of AI that chip manufacturers would do so well, but Intel did terribly. Super Microcomputers having some sort of governance problem, minus 67%. Other companies which are regarded as kind of value companies like Estee Lauder, minus 47%. Basically, for me, what this just shows how difficult the stock picking game is. Okay. Now we look at the contributors to the index. The S&P 500 index, just to remind you, is a market cap weighted index. They take all the companies in the United States, rank them by size from the biggest to the smallest, and they take the top 500 and they rebalance that, I think, once every quarter. That becomes your S&P 500. Okay. So your bigger companies are going to have a greater contribution to the index performance. And this is interesting. We've got NVIDIA, Apple, Microsoft. If you take the top 8 companies, they contributed 60% of the performance of the index. So 8 companies, which represent a 35% weighting of the index, only 8 companies out of 500 gave 60% of the performance. On the negative side, if you take the worst 8 companies, they only had a negative contribution of 1%. So you get a very top-heavy index performance, and we need to take that into account going forward. Not all good news coming out of the USA. One of the economic points we look at is credit card loans, delinquencies above 90 days. The actual number here is not very important, but the trend is a worrying signal that certain parts of the US who use credit cards, not everyone, but a certain part who use credit card loans and are rolling those loans, are starting to feel the pain of higher interest rates. So that's kind of a worrying signal. It doesn't necessarily mean that there's a crash coming, but it does mean that maybe economic growth will come down a little bit. Another thing that's sort of an orange flag or a red flag in our minds is, I'm sure you've read about this, the overall level of US debt. Okay, at $36 trillion. When you look at a government debt, you don't look at it in absolute numbers. You look at it relative to the size of the economy, and the US debt levels relative to the current size of the economy are approaching World War II levels, which is very high debt. Is there anything that we can do about this? No, because the dollar is still the strongest economy in the world. Will Trump and Elon Musk, with their Department of Efficiency, reverse this? Not easily, okay? And certainly not in the first year of being in power. They first have to fix a very unhealthy budget deficit. They have to reduce government spending, increase taxes, which they said they won't do. So there's a lot of challenges there to fix this. It's going to take time. So this debt overhang is going to be there for a while, and it's probably going to grow. It is a strategic concern. On the flip side to that, on the positive side, we've got a thing called the wealth effect, okay? You've got this both in the United States, and interestingly, you got it in Israel too. A very high percentage, or according to this graph, which comes from the University of Michigan, the median American has the largest stock portfolio ever. Basically, what this wealth effect is saying, and there's different ways to sort of present it, the Americans have never been richer. I think that is consistent with what you've experienced. If you go to America, you'll see that the inflation is very high, but people are still spending, and Americans are wealthier than they've ever been. So it doesn't apply to all Americans, but certainly those with money are wealthier than they've ever been. Add to that Bitcoin and property, and you get the consumer engine of the US is still quite strong. Growth expectation by the IMF. Okay, this is starting to go into the tea leaf space. And these numbers are 2023, 2024, 2025 predicted growth. What is this? The number here is less important. The takeaway points are as follows. One, the world relies on the USA. The USA is by far the engine of the world. It's always been that way, and it's likely to always stay that way, or at least for the foreseeable future, regardless of your views on Trump. And the essential principle behind economic growth is that economic growth filters through to stock market growth. Not month by month, sometimes not year by year, but generally speaking, there's a very strong correlation between economic growth and stock market growth. I once presented this to a client. The client went away and did like a whole thesis and studied the correlation and came back and said, you know what, you're right. There's a very strong correlation between economic growth and stock market growth. So this is comfort area number 2. Remember, comfort area number 1 was the 3-year return on the S&P 500 is not out of line with the 15 years. Comfort area number 2 is that we're still expecting positive economic growth in 2025, unlikely to be a recession. Obviously, anything could happen, and political events can obviously affect it, but the economic foundation of 2025 is reasonably okay. The expected growth is actually lower than 2024 and 2023, but still an okay number, and that should filter through to the stock market. Right, let's address this very, very contentious issue of, is the stock market expensive or high? Expensive and high are not necessarily the same things, but one measure, and I have to emphasize it's just one measure, is what they call PE ratio, your price earnings ratio, okay? This reflects how many years of earnings are reflected in the price, okay? It's a pretty simplistic measure. In my view, it's an overly simplistic measure. But if you've done it consistently over time, then you get some reference point of how much growth is being priced into the market. So you do get a sense of it, but it's not reliable. How do I know it's not reliable? Because if it worked as a trading strategy, if you could use PE ratio as a trading strategy, then active managers would do a hell of a lot better than they actually do. And active managers most time fail to beat the index. So we know that one of the main data points used by active managers doesn't work. So having said that, it's still worth discussing. What is a normal price earnings ratio? Okay, I'm an accountant by profession, and I can tell you there's a lot of complexity in expressing earnings, especially in a single year. There's a lot of accounting tricks that can be done that are very company specific. There are variations of this price earning ratios. For example, what they call the the cyclically adjusted price earnings ratio, where they take 10 years earnings. That's it's a different story. What I'm looking at here is the simple price earnings ratio. The data is from Bloomberg. One reason why price earnings might be misleading is it ignores the balance sheet. You don't know how much cash these companies are sitting on. You don't know what assets they're sitting on. All we're looking at is earnings in price. Okay, so that's my disclaimer that it's not a definitive criteria. Just because these numbers are high, and they are high, doesn't mean the stock market is tremendously overvalued. Okay, let's look at the numbers. So the mega cap 7, your average current price earnings, which is backwards looking, okay, in price is 62 years, which is an outstanding number, actually. But if you look at their forward PE, immediately it comes down to 43, and that's a straight average of the 7 companies. But let's look at the median. Why do we look at the median? Because Tesla is insanely overpriced on the basis of price earnings. Tesla is trading at a current PE of 204 and a forward PE of 133. Now, Tesla is only 2% of the index, not small, but these are very high valuations. If you think of Tesla as an automobile manufacturer, then it is hopelessly overvalued. But the market is saying and expecting much more from Tesla than car manufacturing. They're being valued as an artificial intelligence company, as some sort of data company or robotics company. So there's expectations of things there which go far beyond automobile manufacturing, and it's up to Tesla to deliver because the expectation is there. So let's take Tesla out, and we look at the forward PE of the median PE of the 7, and you get 32. And what's a reasonable number? 16 to 18 would be a reasonable number if you bought into this whole price earnings story. And 32 would imply that there's a lot of growth locked in or bought into the price of the mega cap 7. Now we look at the other 493 companies in the index, which make up 66% of the index. The average PE using historic profits is 34, also a high number. And then your average forward PE is 22. So if our expectation is 16 to 18, okay, and the forward PE on the rest of the companies is 22, then on a valuation basis, the other 493 are only slightly expensive. Not terribly expensive, slightly expensive. But the conclusion from this, and all other things equal, the conclusion for this is that the mega caps are indeed expensive, okay? Does that mean we need to sell the S&P and run for the hills? No, it doesn't. But I believe that the premium will always be maintained. The mega caps will always trade at a premium in price compared to the other companies. They may come down together, but I believe that there are very good reasons why these companies are going to remain expensive relative to the rest. Okay, one of those reasons is the structure of the stock market, okay? And I've said this before in a webinar, and I'll keep saying it again. The stock market is not about valuation. The stock market is where a willing buyer and a willing seller meet, okay? It reflects price. Price is when the buyer and the seller have different reasons for buying and selling. Both, if they're using valuation, the seller will say, okay, I believe the stock is overvalued, and the buyer will say, I believe the stock is undervalued. But not everyone who is a market participant is considering valuation. There's a lot of people who are completely insensitive to market. There's a lot of automatic buyers of the index. For example, asset allocators like ourselves, like Pioneer, or more specifically, the very large pension funds around the world, they allocate money to the S&P 500. It's a core holding for them. If they're going to be tactical, they're going to do it elsewhere. They have an asset allocation plan. For example, say 25% goes into the S&P 500, and every month new money comes in from savers into the pension fund, and they will buy 25% of that money will go into the S&P regardless, almost blindly, okay? I looked at the two largest pension funds outside of America. That is the Norwegian Sovereign Wealth Fund and the Japanese Government Employees Pension Fund. Both of them are in $1.567 trillion funds. Both of them use an asset allocation methodology similar to Pioneer, and they will allocate, the Japanese Government Pension Fund allocates 25% to passive instruments in the United States, and the Norwegian Sovereign Wealth Fund allocates 36% to the US market, of which the bulk is passive. Even in Israel, okay, the largest pension fund in Israel is called Amitim. Huge number of assets under management. They have a 40% allocation to stocks, of which currently 70% is in the US. And of that 70% in the US, it's predominantly passive, okay? It's all public information, it's not a secret. And that means roughly 25% of the monthly savings of the Israeli public, and Israel's a relatively small player, but at least we can relate to that. In Israel, the compulsory savings rate is very high. The employer contributes between 25 and 35% to pension, and the employee contributes between 5 and 10% to pension. So that means every single month, more than 40% of your paycheck, of your payroll, is going into long-term saving. And of that, 25% of that amount is going into the S&P 500 blindly, regardless of valuation. Does this mean the market can never fall? No, it doesn't. But it does mean that there's this constant buyer, and the buyer is what pushes up the price. In August this year, in late July, early August, over a 2-week period, the S&P fell 10%. By the end of August, it had already recovered because the buyers who pushed the price back up had returned, and the sellers, for whatever reason that sell-off occurred, I think it was driven by a Nvidia panic, and very quickly the market recovered. So the point is that valuation is not the be-all and end-all in the stock market. There are a lot of players who are long-term thinking. Believe me, the Japanese government pension fund is not worried about the market in the short term. They are thinking 30 years into the future, and therefore they do not care what the current price-earnings ratio is. Here is a screenshot from the Norwegian Sovereign Wealth Fund. It's all in English. It's a ginormous number of Norwegian krona, but it's $1.6 trillion. And you can see their asset allocation, how much to America. 36.9% of all investments are in US equities. Okay, so just to give you some comfort there, that there are some mega buyers, and these are not price-sensitive buyers. Okay, so that was source of comfort number 3. Source of comfort number 4 is trying to time the market doesn't work, okay? We've said this before in webinars. It's very, very, very difficult to time the market and to get that right. Either you can rely on luck or you stay invested. The research says a very, 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 there's a small number of days contribute to a large number of performance. So if you miss those good days, which are a very small number of days, that gap that you missed compounds over time. You never catch that up. So over 1 month, you say, okay, so I missed that bounce. But when you look at your performance in 10 years' time and you look back at what you missed, those important days that you missed because you stepped out of the market for a second, that's going to cost you a lot of performance in the long run. So that's why the cost of trying to time the market is actually might be worse than the threat of it losing 20% tomorrow. Price earnings is only one factor. The question is, well, maybe we should buy a hedge. Maybe we should buy a put option on the stock market if we think it's high. Now, a put option is like insurance. It costs money, okay? And not cheap money, all right? If you're going to protect your current value of your equity portfolio, so what they call an at-the-money option, that's going to cost you a lot. And if you're wrong, you lose that money. An interesting thing, when you think about hedging like insurance, think about your car, okay? Imagine you do not have insurance on your car, and that car has an accident, okay? You'll be out of pocket by the cost of that repair. With the market, when you don't have insurance, okay, and the accident happens, meaning the market falls 20%, there's a very good chance, in fact, almost given enough time, 100% chance that that will recover. So it's like your car is going to fix itself with time as long as you're patient. And that is a big, big difference compared to buying insurance on your car. So to hedge costs money. One of my clients who may actually be on this call, I often quote him and he says, the only perfect hedge is a Japanese fence. So there's hedging costs. There's no such thing as hedging. I would say your most perfect hedge for a high market is asset allocation. That mix of risky assets, which include equities, and less risky assets, which is your bonds. That combination is asset allocation, and that is your hedge. If we're wrong about the stock market and it falls 20% in 2025 for whatever reason, your bonds will not fall 20 or 25%. Your bonds will help protect you. And that is the basis of asset allocation. So you're not all exposed if something bad happens and we have another negative year. And then that is equity investing. You have to understand the inherent nature of equities, that they can fall at any time. And the long-term disciplined approach is the best approach. It's worth revisiting why we expect the market to continue going up over time. Why do we expect the S&P to continue going up? One reason is economic growth. I told you about that correlation. The other is inflation. As that 2 or 3% official inflation, whatever it is, filters through the companies, through their prices, into their revenue, into their profits, that also pushes the stock market up. And then, of course, there's dividends. And all those three contributing in different ways at different times, those three things generally push the market up. So this is another research piece just emphasizing how expensive it is to try to time the market. So according to this, if you miss the best 10 days between 2003 and 2022, so that means you're like really going in and out of the market, in and out of the market, your long-term performance is 50% worse than if you just bought and kept your eyes closed. And that's because the compounding nature of that gap that you miss. Another way I like to show and to get comfort about the index. So people say to me, the S&P is at a record level. It's at 5,000. The date of this screenshot from Bloomberg. Here's the S&P, 5,970. Okay, that's the level of and people say, wow, that's a record. But the S&P, this white line, okay, 5970, has come a long, long way. And if you go back in time to 2002, say, when it was around 600 or 700, okay, every time it went up from 700 to 701, 702, each time it broke a record. It's supposed to do that. It doesn't reflect anything. As unreliable as price earnings is, I would rather rely on that than on the absolute number of the index. It's meaningless, okay? The blue line on top just shows you the power of compounding that dividend. So you stay in the market, you get your dividend, you reinvest your dividend, and you can just see how that compounds over the long term. So that's another reason to stay disciplined about your equity exposure, even if you have some fear that it's overvalued. Remember, over this time frame in front of you here, from 2000 to 2024, there were plenty crises along the way. We had the dot-com bubble, the global financial crisis, the 2011 European crisis. We had the 2018 Trump story. We had COVID. We had the Ukrainian war with surprise inflation. So we've had no shortages of tests over the last, and I'm sure the future will be the same. There will be crises in the future. And although I do expect this path to be replicated in the next 25 years. Let's see. Another source of comfort is this story of artificial intelligence, okay? Now, if I compare myself, all right, I'm not a tech wizard by no means, but I compare myself today to 1 year ago. 1 year ago, I had never used an AI tool. During 2024, I used ChatGPT a few times, and I messed around with a few other AI apps, and I encourage you to do the same. Okay, the message here, these things are scary powerful. They're scary powerful. They are really, really amazingly powerful things. And no doubt that the chips invented by NVIDIA, which allow artificial intelligence, are going to completely change the way that we use computers and we use the internet. There's a big change coming. This artificial intelligence is not just one more iteration. It's a big deal. You have to use it to see it. And you can use it professionally. I've used ChatGPT to research some of the stuff in this and other webinars. I've also used ChatGPT to write a poem, a funny poem, to my wife on her birthday. You could do that. You put in, the more information you give it, the more it gives you back. So you say to ChatGPT, please write me a humorous poem for my wife's birthday. And you give some other positive attributes, number of children, whatever, and you get, boom, in 2 seconds, you get a very funny poem. It's really powerful. Notebook LM, shown to me by one of my colleagues at Pioneer. You take a presentation like the one I'm presenting to you now, and you copy and paste into Notebook LM, and it turns it into a podcast. You have two computerized voices which sound natural voices, and they will create a podcast about my presentation. I was blown away by that thing. It's absolutely incredible. Shortwave, shown to me by a friend of mine. This thing goes through your email. It's an intelligent search and reply system of your email. It can drop, you can tell Shortwave, go through my emails between this date and that date with this person and draft a formal reply rejecting his proposal. And then boom, it does that for you. So these type of things, they really are powerful. They haven't all been monetized, but they are definitely going to change the way we use the internet. In my opinion, the mega caps are going to dominate this space. And I think the market is telling us that as well. The reason these companies are trading at very high earnings multiples for whatever that's worth is because there's an assumption that they are going to make more money from artificial intelligence than everybody else. If some startup creates an app based on AI that is very, very good, then one of the big companies, Google, Meta, Apple, whoever, are going to buy them with their very high valuations, pay crazy valuation on a share-for-share basis, and they will gobble up the new AI and incorporate it into their core offering. So this is one of the reasons why mega caps are trading expensive and are likely to stay expensive. This is an interesting piece which was sent by one of the banks that I follow. The point here is it's looking at the three prior major technological advances. One is personal computers, the other is internet, and the other is cloud computing. And what this says was, at the time that this technology came out, the expectations about the size, in retrospect, if you jump forward to today and look back to what we thought then, they're actually massively, massively understated. So in 2000, when the internet was being commercialized and we had the dot-com bubble, which was a real bubble, okay? Those most optimistic expectations about internet use, with the benefit of 22 years looking backwards, understated. They didn't overstate the valuation, the use of the internet or the potential of the internet. They understated the potential of the internet. So looking at AI, there's a good chance that it might be overhyped if you're in the AI space and you're reading about it, but there's a potential that it is bigger than we think. If it doesn't, I do think it's one of those technologies that will create a bubble, and we need to keep an eye on valuations as this goes through. But from my mind, it's the main reason why mega caps are priced at these very high valuations. Okay, so that's another source of comfort. Now let's talk about Israel. And we're running out of time, so I'm going to do this a little bit faster. These are slides from a Bank of Israel presentation that I attended not too long ago. And I will try to do these pretty quickly. So before the war, Israel was heading into this thing with a very strong economic ground foundation. We had strong GDP growth. We had a good recovery of debt to GDP down to 60-odd% before the war. We had it here. There's a little boost with Corona. It shot up from 50-something to 70. So we had a strong balance sheet. We had low inflation relative to all the other OECD countries, and we had pretty strong employment statistics. Growth expectations, depending on who you follow and who you read, for next year are positive, somewhere between 2 and 4.5%, whatever that means, but it's positive. It means, and depending which economist you follow, they say the budget deficit expectations are between 4 and 6. My view, I think 6 would be fantastic, given the spending the military spending that has to happen in 2025. I think 6% would be a fantastic result. Unemployment rate is still strong. Bank of Israel expectations about inflation. So they say they're expecting a little bit of an uptick in inflation at the beginning part of 2025 and then coming down in the second part. My team, having discussed this, we're a little bit skeptical. We think the inflationary pressure in Israel is upwards, nowhere near previous conflicts. Okay, in 1982, the first Lebanon War, there was hyperinflation which followed. We're nowhere near that world. Okay, that's not going to happen. And what it does mean is we don't think shekel interest rates are coming down. If you have a shekel mortgage or if you have shekel cash in the bank, we don't think those interest rates are going to change much downwards, at least in 2025. VAT is started to be 18% from the 1st of January this year. That's slightly inflationary. And there's reserve soldier payments. And we all know some young reserve soldiers who've received money from the state for their many, many months of service. Well-deserved every penny, no doubt. But there's a lot of youngsters running around with money that they didn't normally have. And they're going to be spending it on consumer things. All right, whatever that may be, and that could have an inflationary impact. Another graph I liked is how quickly Israel has bounced back economically from previous conflicts from 2000. This conflict is much bigger, obviously, but still the signs are that the bounce back is there and quick. Just for a little bit of fun, I wanted to do a poll. I'm not actually going to do a poll because there's no time, but who was the best performing stock market from the 1st of October, so before the war, till the end of 2024, comparing, so I've excluded the USA, Israel, Germany, France, UK, Japan, South Africa, Mexico. Take a guess. Cha-ching. Yes, Tel Aviv was the best performing stock market in dollars over that period, followed by Germany, then Japan and South Africa did well in dollars, Mexico, terrible, UK, 15. And so interestingly, Israel was one of the best performing stock markets over the war period. You had to be in the market to enjoy that. A lot of that came in the fourth quarter. Okay. Tech funding, another point of contention, people saying VC companies are pulling out, startups are crashing. Not true. According to this Bank of Israel slide, I'm not sure how they define tech funding. It's not just startups, okay, certainly at this amount of money that they're talking about here. So what we see is the level of tech funding, whilst much lower than the peak of 2021, is not far out from 2000. It's better than 2017 and 18, and it's pretty similar to that average 2018-19. So tech funding is pretty strong. Let's, oops, sorry. Okay, so where exactly is the economic pain? Construction, if any of you are building a house or doing a renovation, you would have noticed that your construction costs have gone up, labor costs have gone up. Why? Because there was a 24% of the construction industry was Palestinian workers. That came to a complete stop, and there was a shortage of construction workers. So people are feeling a lot of pain in the construction space, and a lot of construction projects are delayed. So there's less apartments for sale, which is keeping apartment prices high. Tourism has also suffered terribly. The hotel chains, the major hotel groups were rescued by the government spending on internally displaced persons. But make no mistake, the tourism industry has suffered pretty badly. Small businesses in the north have suffered terribly. Our debt to GDP has suffered, so we're now at closer to 70% debt to GDP. And the price of debt, when Israel goes to the market and raises a bond, then it's going to pay more than it would have paid prior to the war. Let's do another quick poll. Again, I'm not going to ask you to answer, but you can just answer in your head. Which was the best performing currency from the 1st of October through to the end of December, October 23 to December 24? Shekel, yeah, the usual suspects. And it's the shekel. The shekel was the strongest performing currency throughout that period of the war of these major currencies. Yes, heading into the war, Israel was facing political reform, which definitely weakened the currency. But arguably, that political reform is still on the table. It hasn't gone away, and the shekel is still strong. There's a lot of questions about my predictions on currency, which I hate doing, but I'll get to that when I get to the questions and answers section. Another interesting thing which we have talked about in the past, and that's the correlation between the shekel and the S&P 500. Remember what I said about Amitim? 25% of most of the pension funds in Israel are invested in the US market one way or another. They like to hedge that. So as the market goes up, they're buying shekels to hedge more. As the market goes down, they're selling shekels. So we see a correlation between the equity market of the S&P and the strength of the shekel. That correlation broke down during the 2023, during the period of political reform, but it's been going for quite a long time, broke down temporarily, and it seems to have restored itself. So now we see a normalization of that correlation. What does that mean? It means predicting the shekel in the short term also means predicting the stock market. So both which are very difficult to do. So, but it does give you some indication. If you suddenly read about the stock market crashing, then you can expect the shekel to weaken quite quickly. Right, 2025. I like this image because I think you all know the world that we live in. And there's a lot of unknown unknowns and there's a lot of known unknowns. So we looking at 2025 as asset allocators, we have to stick to our strategy. We're not making any major predictions. A lot of things can happen, obviously, in 2025. And most importantly, the world does seem to be a little bit fragile. So economically speaking, at least, there seems to be a reasonably solid foundation. However, there's an increased political polarization. All right. We've seen it in Israel. We've seen it in the United States. We've seen it in Europe. There is political polarization. Markets have accepted this polarization and assume no drastic political action will happen and that rhetoric will remain rhetoric. For example, Trump tariffs, you've read about them in different contexts, depending on the media outlet that you're reading, but tariffs are inflationary. And Trump is using tariffs and threatening to use tariffs as a tool to implement foreign policy. From our point of view, we can't make a prediction on which countries Trump is going to put tariffs or not, and what will be the implication for the US economy. That we cannot do. We do believe that Trump will not do something which is overly detrimental to the US economy, okay? But it's an assumption. At this point, I want to just take a little bit of a risky discussion. I want to share with you my experience about political influence on portfolio strategy, okay? I get a lot of strange requests from clients, and I believe your personal political views should have no place in portfolio construction. I'll give you examples of the types of requests that I've seen. In 2016, when Trump came to power, I had a client who was very much anti-Trump, and he said he does not want to be invested in the S&P 500. You can imagine how much that cost him in performance if he stayed out of the market, which he did. Okay. Yes, politics and economics and markets do overlap. They tend to overlap in the long term, but they overlap less than you believe. Another example is ESG. So some clients come to us and they say they want their money invested in a more clean or ethical way. So that's the concept of ESG, which is controversial in itself and how it's constructed. But if you put this political overlay on your portfolio, then it's hard enough to make money without these constraints, but generally speaking, political constraints. Another example is during the political reform in Israel, if you took a pessimistic view and took your money out, then you would have missed out on that plus 25% on the Tel Aviv Stock Exchange. Just something to think about, that generally speaking, political views should stay out of portfolio construction portfolio construction. Crystal ball for 2025, cautiously optimistic on economic growth, should go through to the stock market, and therefore we're kind of expecting another positive year in the stock market. I don't believe it will be as strong as 2023 and 2024. Short-term rates coming down. Okay, so you're going to earn less on your cash dollars. We expect that to finish around about 4, even 3.75. The 10-year treasury, which is longer term rates, which affect your bond portfolio, we expect them to stay more or less where they are. And we're kind of hoping for a boring year on bonds where we'll just collect our coupons. I believe the AI theme has got a lot more way to go to add as a source of risk appetite in the markets. Europe remains unappealing as an investment case. We can talk about that, but it's unappealing. USA will continue to dominate, and therefore we will continue our USA overweight in equities. Lots of geopolitical unknowns which could affect the market naturally. Trump deregulation will promote a higher deal flow. US taxes are likely to stay low or possibly lower. There will be a lot of Trump noise about tariffs. I mentioned that. Labor market, there are some signs of weakening of the labor market, but we know that Elon Musk is going to fire a few tens of thousands, if not hundreds of thousands of people in the government. So we have to see how that's going to roll out. China is still strong in terms of size, but the market is too volatile for investing, in our opinion. Taiwan, in my opinion, is the major geopolitical risk. As you hear Trump noise about tariffs in China, so too then you hear about Chinese talking about Taiwan. I think it's a stalemate. I don't think anything's going to happen, but if anything does happen, then that's going to be a red flag. Don't forget Elon Musk, Trump's new buddy, has a factory in China with 20,000 employees and has a massive investment in China. So it's hard for me to believe he's going to do anything detrimental to Chinese-US relations. Some questions received on registration. Okay, I'll try to do this as quickly. Where do I see the shekel in the next 6 months? Currencies are very difficult. The shekel dollar, I think, will be between 3.6 and 3.7, maybe 3.55 if the stock market keeps going up. It's hard for me to imagine stronger than that. Obviously, there's a lot that could affect that. And on the pound shekel side, similar, somewhere between 4.5 and 4.8, somewhere close to where it is currently. I don't expect a major change. How much of your assets are invested in the Israeli market? Roughly 25% of what Pioneer manages is in the Israeli market, maybe a bit more. Outlook for US interest rates, I mentioned. Short-term coming down, long-term pretty much where they are. We discussed, are the mega caps overvalued? I believe they definitely are expensive, but I believe they're going to remain expensive, and putting options on costs money. Besides that, there's some regulatory issues around buying options in our business, so not so simple. Debt market spread, I mentioned that in the beginning about bond spreads being tight, but we're still buying bonds because we don't really have a choice. This is an interesting one. Fixed income investments have significantly underperformed equity market for 3 straight years. Most of the damage was in 2022. Do you feel this trend will continue? And if so, maybe it makes sense to lighten up on bonds and to go short duration. Okay, lots of things going on there. I don't like to compare stocks and bonds because they're very different animals. And we use them together to manage risk. Bonds have done terribly because of 2022. I do not expect that to happen. I expect relative stability going forward in bonds. But in bonds, in a conservative bonds, you know, if you make between 5 and 6% on your bonds, if equities continue doing what they do, at least our expectation of equities is higher than that. So, but it's a risk question, not a performance question. Treasury bonds not doing too well. I think that has some 2022 overlay. Certainly in Q4 this year, treasuries didn't do so well, and we managed that by keeping duration relatively short. I'm sorry to be rushing this, but I wanted to wrap up within 1 hour. I think I answered this one about Trump and the US stock market. If I was going to invest in one sector in 2025, what will it be? I hate questions like this. The sectors that we still favor is financials, even though they've done very well. I think in terms of opportunity, because we feel, you know, there is a feeling that perhaps the stock market has a little bit more risk than it had in it a year ago. Maybe a structured note linked to the equity indices, targeting 9 or 10%. I'm happy to discuss offline what is a structured note, but structured notes are particularly interesting in this environment. Given the current market high, can we discuss that? How many years before retirement is the correct time to shift to less risky ones? This is a very personal question. It's an asset allocation question. I suggest you discuss it with your financial relationship manager. It varies. I've got clients in retirement who are 100% equities because they know this money is for their grandkids and not for their own retirement. So it's a very personal question. And will the US power ahead of Europe? Yes, I believe it will. All right, so that's, let me just have a look if there are any questions. What is going to be the interest rate on a fixed deposit, say for 1 year? So in the low 4s for dollars, I think is what you're looking at there. For the S&P 500, does it make sense to go with an RSP like an ETF rather than SPY? I'm not quite familiar with RSP, but if I assume what you're asking, I don't actually understand that question. I think that mega caps are unavoidable. If you wanted to avoid the mega caps, there's an equal weight ETF that instead of overweighting the mega caps based on their size, it weights all 500 companies equally. That's probably the way to avoid that. Are we concerned that AI growth will be limited by available energy, which is required? No, I don't know the answer to that one. RSP is equal weight. Okay, yeah. So the equal weight is one way to play the market. We've been watching equal weight for a while. We've got it in some of our portfolios. It tends to you know, you need a strange set of events for equal weight to work, because if the market goes up, equal weight's going to underperform, and if the market goes down, you're going to feel that too. So equal weight is not a great concept, but if you wanted to exposure without the mega caps, then that's probably the way to do it. Okay, so that's all the questions. Thank you very much for your attention. I hope I didn't speak too quickly. I hope that you enjoyed. Please feel free to email us questions afterwards, and thank you very much. I wish you all a happy, prosperous, and most importantly, peaceful 2025 with the hostages home. Thank you very much.